So ladies and gentlemen, it's now time for us to pivot our focus to investment innovation, the topic that acts as a beacon for our nation's future, private equity. And we have a panel discussion coming up for you next. So as we set up the stage, bear with us just a few minutes. I'd like to also take this moment to say thank you to all our sponsors for making today possible, for making TiEcon Mumbai 2025 possible and a success. And of course, ladies and gentlemen, I'm sure you will be taking a lot of photographs throughout the day. If you are posting on social media, please be sure to use the hashtag TiEcon Mumbai 2025 and tag us as well. Just bear with us a few moments and we'll welcome our eminent panelists to the stage for them to share their perspectives with us on the evolving world of private equity. So ladies and gentlemen, let's welcome our panelists to the stage. I'd like to start off with our moderator for this panel discussion, Ritesh Chandra, Managing Partner at Avendus Future Leaders Fund. A round of applause, please, for Mr. Ritesh Chandra. Come on, ladies and gentlemen. I know it's early, still relatively early, but let's make some noise and welcome our panelists. Keep that applause going, please, for Manish Kejriwal, Founder and Managing Partner at Kedaara Capital. Make some noise, ladies and gentlemen. Cyril Shroff, Managing Partner at Cyril, Amarchand, Mangaldas. Let's have a big round of applause for Mr. Cyril Shroff. And last but definitely not least, Renuka Ramnath, Founder, Managing Director and CEO of Multiples Alternate Asset Management. Let's have a big round of applause for Ms. Renuka Ramnath. Mr. Chandra, I'll hand the stage over to you, sir. Thank you.
A very good morning to everybody present, and thank you for taking out the time to be here. It's very heartening to see a crowd early in the morning listening to, I think, what promises to be a very engaging conversation. We've got the stalwarts of the private equity industry here, both in Renuka and Manish, as well as legal doyens like Cyril around with us. So we hope to get a very entertaining session today. You know, if I may just kick off, see, private equity has become an extremely important asset class when it comes to capital in India. India is doing anywhere between $45 to $50 billion of private equity investments per year. And you know, one of the key features when I look at the market structure has been domestic funds and their ability to raise significant pools of capital from global institutions very successfully. The one question that I would want to ask Renuka and Manish is basically, how do you distinguish yourself? How do domestic Indian funds distinguish themselves in the global marketplace? And you know, what makes us stand out? Manish, if I can kick, or Renuka, either which you want to take.
So, good morning. Very happy to be here, and thank you for this invitation. I think over time, each of the investment firms, whether global or local, have clearly evolved a style of investing as to what works for them. For instance, if you look at Multiples, which is a firm that I run, for us, minority investments in very strong partnership with entrepreneurs who have a potential to build category-leading companies is a very distinguished strategy. For some of the large global firms, just the ticket sizes themselves are very, very different. So if you look at a Blackstone or an Advent, the threshold for ticket size makes a big difference. So One is in terms of investment strategy. At what stage are you willing to invest? Do you do necessarily only buyout transactions, or are you also open to growth transactions? What sectors do you really specialize in? And the investing style, what kind of companies you prefer, right? And how do you really add value to the companies, are all ways in which firms have distinguished themselves and created a unique positioning and story.
So, great to be here. Thank you, Ritesh. I just want to set the context on how the industry has evolved. To your question on large funds in India, if you go back 15 years, there were a plethora of funds in India, but there was no DPI, there was no return of capital to our investors. So as an industry, it was struggling. The biggest change that both Renuka, I, and many others who are domestic private equity players have benefited from is the industry as a whole has matured, and we've had a significant amount of money going back and very high levels of DPI. I'll use our own example. The reason I may be looking a bit tired is we've had AGM the last 2 days. It got over at 1 o'clock last night at a dinner. But it took us, when we started in 2012, 2013, our first one was, which is always the toughest to raise, was we raised about $500 million, but it took us 2.5 years. We closed our fourth fund in the beginning of last year. We raised $1.74 billion, but the demand was much more. We cut it off at that amount, but it was done in 3.5 months. At a time when the global environment for fundraising was extremely challenging, especially for the venture capitalists, because there was no DPI, there was no capital being returned to your LPs. So the LPs actually had a shortage of capital. I compare that to our fundraise, where, so in my mind, irrespective of what the product might be, whether it's venture, even earlier stage angel, growth equity, buyouts, we do buyouts and growth. It doesn't matter what the strategy is. The only thing, and also remember, this is a very illiquid, long-term product. You're going in for an 11-year, 12-year commitment from the time you put your money in. So it has to be a very sophisticated investor. As investors, you should be demanding a significantly higher return in order to play off the illiquidity of the product. So it's truly not for the faint-hearted. It is for the sophisticated investor class. And I think what I was getting to is, irrespective of what the asset class might be, as far as you have delivered two things. One, consistent returns. It doesn't need to be ridiculous returns. I think an LP would rather see, let's say, a 20% net IRR over 7 funds than 3 funds with a 40% return and 3 funds with a 0% return. I mean, just as an example. So I get back to saying, single most important thing is your performance, and consistency in performance more than variability. But second, I think, is the level of institutionalization of the firm. You are taking a 10-year bet. You've got to make sure if 1, 2, or 3 people are run over by a truck, hopefully that doesn't happen, the firm continues. So more about that later. But to me, it's less the strategy, it's the performance and the level of institutionalization.
Sure.
Ritesh, if I may also add, I think your question was, how do local firms like ours distinguish from global firms? I think a very deep understanding of how India works and what it takes to build a business in India. Correct. The ups and downs. I like to think of India as currently a 6-lane highway where suddenly you can hit a pothole. So you can't just put on a cruise mode and close your eyes. And therefore, what kind of businesses, what kind of people, what kind of investment thesis that you are underwriting, and the capability to navigate it, and the capability to sell that opportunity internally to the IC are, I think, far different for domestic funds than international funds, who would still have to operate within a narrower confines of what would work for those firms, where the decision makers are sitting in a totally different geography. Yeah.
That's insightful. Thank you. Cyril, sorry. Cyril, my next one's to you. From a legal perspective, what is it that the regulator can do to enhance the scope of activity that is happening in the PE industry? And what do you think can deepen the market and broaden the market further?
So first, I just want to sort of supplement Renuka's point on, anything can happen in India. And that is kind of what distinguishes between homegrown funds versus international funds. I think funds like the panel that is sitting here are far more aware of the uncertainties of the Indian environment and are much better able to sort of cope with it. And we find that, and one of the big risks that can come from anywhere is legal risk. There is always some bombshell sitting somewhere which will explode at the most unexpected time. So I think that I would, supplement that as a big cultural factor which distinguishes, different funds. So to come to your question in terms of regulation, I think firstly, the Indian policy environment has accepted private equity as a good asset class. I think there's a realization that if India has to achieve the dreams of Viksit Bharat, that private equity is going to play a big role. I mean, it is a very important source of capital, both domestic as well as foreign capital, which is absolutely required. So the level of respect with the regulators for this class has gone up exponentially, and I think this is something which has happened in the last 7-8 years. Before that, there was always that little bit of suspicion about, the barbarians at the gate type of, that kind of sentiment, which is not there anymore. And that has manifested itself in so many different forms in regulation. So first, let's just talk of FEMA as well. That the restrictions and the enabling framework created in different sectors for accepting foreign investment has been liberalized so much that what was earlier taboo is now possible. For example, say insurance as well, and so many different varieties of sectors which were otherwise considered sensitive. So just the gradual opening of the gates for foreign investment has been one category. The second, I think, is flexibility of pricing. We've always, India has culturally always had this, price high at entry and price low at exit philosophy, which has also now sort of largely moving towards a market-based model. So I think that is another change that has happened as well. As far as public markets are concerned, there has been a lot of improvement as well. There's still much more work to be done. But I think public markets, firstly, we should think a minute about, why is it that, at least in the last year, that India had the highest number of IPOs in the world. 24% of all global IPOs happened in India. And I think there's a reason for that, which is, I think, our approach towards various asset classes, including private. So many of those, I think nearly a quarter of those were, or more than that, were private equity led. So the fact that we have completed the value chain of, where there is an exit at the end, and to the extent now that a lot of multinationals who have Indian subsidiaries are thinking of exits in India as a preference over the global one. So liberalization of the exit framework has been another part of it. Your future question of what needs to be done, I think a bunch of things need to be done, but the biggest one I would say, and it's almost like a regulatory holy grail, is delisting or taking private. The day that happens, I think you'll see a floodgate as well. So we have over 6,000 listed companies, number give or take, maybe more. And more than half of them don't deserve to be listed at scale at least. So how are you going to find a way to effectively take them private? And the day that happens, I think private equity will probably swoop in to take up that opportunity as well. Many SEBI chairmen have tried, and all of them have run into that roadblock of reverse book building. That's where it all burns and crashes. We have a new man. Let's see what he does. So I'm looking forward to that. The day that is solved, I think you'll see a transformation, further transformation. So I'll stop here.
Great. Thank you so much. I think the other significant change that we've seen in the private equity landscape is the emergence of what I call domestic capital. And, clearly, over the last decade or so, it's become a very important source of the liability profile of most private equity funds. Are we there yet in terms of depth, maturity, or the understanding of the product with domestic investors? And, how do you see this landscape evolving going forward? Manish, you want
So, domestic capital is something that I have been nurturing from 2001. I got the job of ICICI Ventures CEO in Jan of 2001. And I was extremely thrilled to be called a CEO. At that time, it looked like that was kind of the epitome of professional achievement, only to realize, 9 months down the line, the September 11 attack happened, and the whole international world turned their back to India. It was a very, very interesting experience. So you can imagine this is like 25 years back when the product was so nascent and India was not on the radar of anybody's map. I had a $47.5 million fund, which was an international fund, raised in joint venture between ICICI and the Trust Company of the West, TCW. One very prominent local name and one very, very prominent international name. Together, we could raise only $47.5 million. So you can imagine how far this country and economy has come. When the September 11 attack happened, every investor in that fund knocked on my door and said, I don't care 10 cents to $1 or a quarter to $1, just give my money back. I'm running away from emerging markets. And here I am with this challenge of having to raise money, and that was for the first time I turned to domestic institutions to raise money and eventually put together a $250 million first fund for ICICI Venture. Barring Temasek, most of them were domestic institutional investors. Fast forward 25 years, today I'm told that about $130 billion of domestic money is there in the SEBI-registered Cat 1, Cat 2 funds. This includes the entire spectrum of private equity infrastructure and real estate, which is a massive number. And every year, we are growing at about 30% from the previous year in terms of the total amount of capital we are able to attract into this sector. I think after a very, very long battle with the government by IVCA, particularly Gopal Srinivasan, finally, on the tax side, government equalized the capital gains tax between public and private markets. Otherwise, private markets were punished for all the illiquidity risk that Manish, spoke about. So today, I would say in terms of awareness of the product, there is a very high awareness. Thanks to what Manish said, that these funds have been successful. We have all raised money. We have returned much higher alpha over the public market equivalent. And we have shown cash to our investors. So a reasonably long track record of consistent performance has already been demonstrated. There are regulations to pool these money, which are, understandable and operationable. So that's also a strong positive. And I think because of the proliferation of wealth management and Indians, many, many Indians becoming more wealthy where they can afford to save for multiplying their capital rather than for getting the interest income for running the household. Both of this coming together has resulted in a very thoughtful allocation to this asset class. I would still like to believe that at this point, the allocation, even for very rich individuals, will be in the 1 to 2% range, and it has a potential to go up to 15%, at least for extremely wealthy individuals. Speaking about Indian institutions, unfortunately, the Life Insurance Corporation of India, who ought to be the biggest investor, is absent. So I would say there has been a degrowth from one of the largest pocketed investor in India. The other private institutions do not have that size of balance sheet, but they do have an attraction towards this product, and they do what is best possible given the size of their balance sheet and the regulations. But the Indian family offices and Indian ultra HNIs are definitely emerging as a very, very important supplier of capital for this product.
Manish, your thoughts?
Yeah, so I am exactly where Renu is on how attractive this product could be and is, and the fact that we need a risk-adjusted return. I just want to make 3 points. One, in our very first fund, we had some people in this room, Ganesh Natarajan, Sharad Sanghi, if he's around or will come later, who were domestic investors in our first fund. And then for a variety of reasons, we did not take domestic capital in Fund 3 and 4. And there were different reasons for that, and I'll get back to it. I think the right answer from a GP's lens is to have domestic capital. Again, selfishly, given what the rupee is happening, I'd much rather, even to my international investors, I can't promise a number, but I say I attempt to give a certain net rupee return. I can't promise a dollar return, because that's a derivative. So the larger portion of my fund, which is rupee denominated, I am naturally hedged, right? So purely selfishly, as a fund manager, that's what we should be doing. The reason we didn't have domestic capital, including from friends who invested early and took the risk, and we feel bad about that, was essentially the demand was so high from the foreign investors, we couldn't. But in our next fund, we will definitely make at least 15 or 20% of the fund available to domestic investors. That's point number one. My second point, this is all so far the glass half full. The glass half empty, and I'm surrounded on both sides by people who raise a lot of domestic capital. My problem with the asset class is the way it's distributed in India. And let me clarify what I mean. We, as a firm, it's not religion, but we have never appointed a financial intermediary, whether it's a consultant or an asset allocator, to raise capital on our behalf. It was most needed for Fund 1, and I said the Indian story and the way we were approaching it with a very significant amount of operating partners, and it's sort of a Clayton Duvallier model which we Indianized, I could barely understand it myself. So how is some third party going to explain that to people who we think we are the custodians of their wealth? We take that very seriously. We don't ever want to misrepresent what a product is. So we have, when we go to domestic investors, what we try to underline is actually the long-term nature of the product and the fact that it's very illiquid. And frankly, if you don't have the appetite for that, and if it's not a very insignificant part of your earnings, you shouldn't be investing in the thing at all. So I go the opposite direction on that front. And what bothers me about the industry, and I've had a bunch of very close friends who run asset management and wealth management companies, today, for the average Joe, what we would call in the US doctors and dentists, and even the more, many of us, including myself, are heavily influenced by your RM and your relationship manager. And what that leads to, unfortunately, if you actually study the economics of the distribution firms, and they do a very important job, don't get me wrong, but the RMs are equally compensated by what they sell into the market. So unfortunately, you could have a situation which exists today of adverse selection, where the GP that is most desperate for funds gives the most highest levels of compensation, and the RM, instead of doing what's best for the client. So what I'm saying is, again, we need to be very careful at this stage of the evolution. Gopal has done a great job. Renu's being modest. She's done an equally good job in making this into a common industry. What we need to be careful is our distribution and our sales channels don't missell this product, because like most things, the baby will then be thrown out of the bathwater, because the regulators will come in. But I do think this product is fantastic for institutional money. So if we were to raise money, we would primarily focus on institutional Life insurance, Renuka referred to that. The reason it works very well for them in India and globally is duration matching. A life insurance product on the asset side is long duration. If you're investing in a long, there's a natural matching.
Asset liability match.
Asset liability matching. So for the rest, it has to be properly sold, the risk clearly exempt, and you cannot promise a return. I can't, but hand in my heart, I can talk about my last one. I can't talk about my next one. So that's all I'm worried about, and I'm worried that the mis-selling will actually be the bane of the industry rather than the boom of the industry as it should be.
And slightly to, because there'll be a lot of entrepreneurs here as well in the audience. The other thing that has become very prolific in the last, I would say from COVID time onwards, is high net worth individuals making direct investments, right? And it looks like if you create a portfolio, you will hit a blockbuster somewhere and you will make more money. So why give this fees and carry to professional fund managers? I would want to sound a very strong word of caution, both for the investor and for the entrepreneur who's taking money from such investors, because like every other financial services product, this is also a very institutionalized product which needs a very robust mechanism for both evaluation of which is a deserving idea and how do you go and build these companies, and finally how do you get exit. So that is another kind of danger that is there in the market.
I couldn't agree with you more. I think one of the things that we've at least witnessed in the last few months, at least 2024 was a classic example where there was a clear preference for direct investments rather than going through a fund route. Cyril, if I may just bring you into this conversation, just in terms of how, and from a regulatory perspective, is there recognition with the regulators that private equity has finally come of age and they can be recognized as a strategic partner with the regulators? Are they looking at private equity at the same manner that they would normally look at any other strategic investor?
I think short answer is yes, but they have stopped short of defining them. And I think that's been a debate that has gone on for a long time as to whether we need to define them and give a kind of form. Because firstly, it's impossible to really define them because private equity also comes in different shapes and sizes. But I think just in terms of recognizing that structures of this type exist and that they need special treatment, I think that has, and there are different answers whether you're talking to a SEBI or an RBI or Ministry of Finance and others. I think they have different, or tax, I think different approaches to this. So I just first want to add supplement a comment which both Manish and Renuka made in terms of the mis-selling. I think this is a crisis waiting to happen. Well, someday there's going to be a train crash on this. And the typical Indian reaction or Indian regulatory reaction to this is then just, slam down and over-regulate on this, which would be the most harmful thing that could happen. So I expect that this will get, there will be regulatory spotlight on this. I think everybody knows what I think is sort of going on, particularly from projecting future returns. So it would be probably a good thing if there is some regulation that is brought in, or at least some safeguards brought in before there is a blow up on this, and particularly in markets like what we are living through. Now back again to your point on, what about this as a recognition with the regulator as an asset class. So IVCA and have made so many representations as well. I've participated in some of them as well. And I think the recognition, at least with SEBI and RBI, it has mostly been, yes, we recognize this. Yes, this is a source of long-term capital. Yes, India's infrastructure requires this. There's a capital deficit, and this is one of the main places from which this funding is going to come. But the response has been to regulate bits and pieces of it: floor pricing, exit pricing. How does the CCI deal with the rights that are there? There is an ongoing struggle in terms of how the Press Note 3 issue has to be dealt with as well. This is one of the pain points. And I think, of course, it's a very complicated issue, given that the, uh, the kind of, at least the literal test is one shared anywhere up the chain as well, which is an extreme view. But nonetheless, these are some of the pain points that need to be resolved. But emotionally, I think the regulator recognizes that A, we want them, 2, that we need to create an enabling framework, and 3, that we need to remove as much regulatory cholesterol as possible. But we haven't crossed the finishing line yet.
Sure, thanks. I think one of the other trends that we've witnessed in the recent past has been the emergence of buyouts by private equity funds. And, you know, it's probably one of the fastest growing modes of capital investment in the country. How do you think funds in India are positioned, and what is the value proposition that they bring to the table when buyouts are concerned? Manish, you want
I think you need to look at both sides, the supply side and the demand side for buyouts. The beauty on the supply side is there are many more opportunities for buyouts. Multi-business conglomerates, essentially becoming far more efficient as you move away from the license Raj. Most businesses, some have gone the other, but most businesses have concentrated on fewer and fewer core businesses, and they've spun out, like you've seen in the US. You've seen that across many of the business houses. We've done partnership deals, what we call partnership deals with families like the Mahindras, where we've taken out their logistics business as an example, and many others like that. So I think one, that's happening. The second, which is happening, is the second generation, third generation entrepreneurs would rather be, I mean, we've all smiled about Uday and Harsh Goenka's tweets and messaging on the next generation. I don't want to go there in terms of discussing that, because I do think it's hard work running a family office also, but that's a different topic we can talk about. But the fact that many in the next generation don't want to do what their parents were doing, mother or father, has given rise actually to most of the opportunities we've invested behind. Most of our control, or what we call partnership deals, doesn't need to be 100% ownership. We've done a bunch of 100% ownership deals like Vishal Megamart, like Aavas Housing, but often when we do it in partnership with a family, it's a two-stage process where we agree to first buy between 40 and 80%. We would like more, and help them increase the EBITDA of the company significantly before they completely sell out. But we agree that it is going to be eventually sold out. So it may not be perceived technically as a buyout up front, but we consider that a partnership buyout. That's one. The second question then is on the demand side. Firms like ours, Renu's also, but also many of the global funds, if you go back again 15 years, the reason we had a bit of a bad name was the only things you had available were minority deals. And I'm not saying that's bad, but the minority deals of yesteryear were ones where we as fund managers broadly were not adding that much value. We were stuck in minority situation. It was left to, I would say, the acquisitions of the promoter to give us an exit. That is no longer the case. The beauty of today is whether it's a control deal or a minority deal. I think most of us are really working hard for the fees that we are paid by our wealth that we are custodians of. At least I'll speak, I'm sure Renuka has an equally, if not better model. Our model is a very high level of, we have probably the highest amount of time spent per dollar that we deploy. Our team is now 73 people. We were 10 people in 15 years ago. We're now 73. We have 20 full-time, 20 operating, we have a team of about 32 investment team members, but 20 operating team members, which were less than 10 years ago. We have 12 of these who are part-time operating advisors and operating partners, such as a Pramod Bhasin. If you do a tech services deal and he's helping out, and the role he plays is that of an executive chairman, or a non-executive chairman, as the role might be. Or we've recently brought in Keki Mistry to help us think through our financial services deal. Having those guys, or Abid, who was the ex-CEO of Wipro for our tech services deal, as many in the room might know, So what we've done on that side is partner the investment team with the operating team to actually effect change. And actually, this is not about strategy and fundraising. We do that also. But the two most important things we do in a controlled situation in terms of time spent is hiring people. We professionalize the CXO level tremendously. And number two, we've had 8 IPOs that we've led, the last one being Vishal and Ajax. We really, that itself is a process that we put into the firm. So I think we're doing more control, but even the last thing I'll say is if we were to do a graph where the x-axis is amount of equity you own in a company and the y-axis tracks either the amount of time or your returns, the common Anglo-Saxon assumption is an upward sloping curve. The more the control, the more time you spend, and the more returns you have. I will be the first one to admit in this room that for us, it's a complete scatter diagram. Despite having 100% control in Vishal, we had such a superb management team led by G.K. Kapoor. We didn't have to put those sort of resources into it. Where we had less than 10% stake in Manyavar, Ravi, who's an outstanding promoter, needed a lot of help. Based, he was a Calcutta, to upgrade the management team and prepare for the IPO. The amount of time we spent on that, and I was telling my colleague Anant about that, was significant. And so that to me is the inconsistency of the Anglo-Saxon model versus ours. And that's also reflected in our returns, unfortunately or fortunately. Often where you spend the most amount of time does not guarantee a good outcome.
Yeah. Renuka.
Yeah. So just taking forward from, while I agree with everything that Manish has said, so institutionalization of ownership is something that corporate India cannot run away from. We are, even today, probably 70% of corporate India is family owned. And this needle will definitely move towards institutional ownership for all the reasons that Manish spoke about. The next generation is not interested in pursuing their parents' business. There are more attractive opportunities. Consolidation. So India is very famous for very many attractive, profitable companies, but in size. The number of large cap companies we have to the size of our economy, and then when you compare it to our aspiration of becoming that 10 trillion, is very, very small. And this is going to happen only through consolidation, where again institutional players like private equity will play a very critical part. Because for a promoter to come from a controlling stake to a minority stake and do consolidation to become a company that is of global scale and global competency is a very difficult task. They would much rather monetize and move on. So there are very many reasons why controlling transaction or co-control, where private equity could have majority, but you would still have continuity of partnership with the founders. All of these are emerging in India. This is a one-way street. This is only going to increase. Private equity firms are becoming more and more capable of setting the strategy, finding the right talent, putting the right governance, and creating the right value and making the right exit in this strategy. And this is a muscle that our industry, people like Manish, myself, we have all built over the last 20 years. I mean, this is, when I first did my first buyout where Tata Infomedia was bought from Tata's, I literally had to go with a kavach that stones are not thrown at me, right? Who is ICICI Venture to buy a company from Tata's? And what do these employees go home and tell their spouses that I used to work for Tata's and now I work for a faceless private equity firm? I think we've come a very, very long way. And as Manish said, I'd just like to reiterate, the biggest change is the way talent is gravitating towards private equity controlled companies. If that was not happening, nothing was possible. Today, the best of talent wants to work for private equity controlled companies. That makes this an even more attractive and a distinctive possibility.
Sure. So we'll have a lot more buyouts coming our way very, very soon. I'm just cognizant of the time. we are seeing several new age sectors, AI, renewables come through. How prepared are we as Indian funds to capture the opportunity? How are we looking at these segments going forward? And do you think we have the chops to make successful investments in this space? The new age sectors, including AI, that's right.
Yeah. No, I'm most excited for the new age sector because this is truly a level playing field. Things are happening simultaneously in the West and in India. And as the previous speaker spoke, India, because of its demographics and tech talent and the Indian market and Indian customers themselves being a very attractive opportunity for testing your AI capabilities and AI model, we are very, very focused on new age sector. In fact, one of multiple's focus has been when e-commerce was happening, we made the first e-commerce bets, then it was digital, we made those digital bets. We have invested in an AI company way back in 2018, and we have seen that company grow fivefold. So I think tech-related and disruption-led business opportunities is a very attractive space for Indian players because Indian market, Indian talent capability, and the fact that it's happening at the same time across the world is a very big opportunity. But how you will be collaborative, how you will look for the best technology and partner with the right companies, the future is for people who can partner well and who can build an ecosystem well rather than to say, I will do everything myself, will be the recipe for success, I would think.
We, as a firm, are slightly more boring in old world, and we would stick to what we historically called smokestack industries. But let me explain what I'm saying. Often, what is not appreciated in investing is the deals you don't do. We used to do one or two deals a year, now we do 4 or 5. We don't want to complicate our lives, we want to keep it simple. So the majority of investing is, if you look at the Indian economy, there's probably 75 or 80% of it we don't know anything about, we don't touch. I will not compete with my friend Ravi Raheja in construction or real estate. I definitely don't want to be in the value chain where there's oil or refining or anything of that sort. I don't want to be in a heavy regulated industry where I need to compete with many of the business houses for permissions or other advantage. So we actually keep out of all that. We stick to 4 sectors that we think we know as well as anybody or better than anybody else, which is financial services and consumer more than anything else. And then we're increasing our heft in tech services and in pharma. And we've actually passed on stuff like energy and EV, and we're not a climate investor, we're not an ESG investor. We believe in those things, but we don't do it because it's a fad. Because anything which had a regulatory aspect and dependent on the government policy, we keep far away from. AI is the one exception. I agree with Renu. It's a very high opportunity. But again, I would look at this as investing in shovels and not in the gold mine. Given where valuations today are on AI companies, I wouldn't dare to attempt and try to choose who the winner is. That's a game for the VC community. They understand it better, they can take that risk. We don't do that risk. But what we do use AI for is the enabler. Today, 2 of our portfolio companies, and we're learning from them what Purple is doing with AI in its value chain. They have significantly reoriented the workforce because of AI. And what Piyush is doing at Lenskart with AI is phenomenal. So actually, we're learning from them, seeing what aspects of AI we can use as enablers for the rest of our portfolio, but as of yet are still shy of investing into an AI company itself.
Got it. I think we've run out of time, but thank you so much, everybody, for a very engaging discussion. And I hope everybody in the audience did find it useful. Thank you once again for being here today.
Ladies and gentlemen, let's give our eminent panelists a louder round of applause. I request you all to please stay on stage for a few moments longer as I invite Mr. Ranu Vora, President TiE Mumbai, to present our eminent panelists with a token of appreciation. Ladies and gentlemen, let's put our hands together one more time for our panelists for their valuable insights that they've shared with us this morning on transforming challenges into opportunities through strategic investments. Thank you, of course, to each of you. Thank you, Mr. Cyril Shroff, our moderator for this panel discussion, Mr. Ritesh Chandra. I'd like to thank Mr. Manish Kejriwal and, of course, Ms. Renuka Ramnath as well. Ladies and gentlemen, you can keep that applause going, please, for each of our panelists as we present them with the token. We'll just get a group photograph. Thank you once again for sharing your perspectives on the evolving world of private equity.